Dah start ke? Okay, dah. Right. So, Assalamualaikum, hello everyone. So, our group is presenting about the interest rate analysis and our group chose South Korea. So, next slide. So, this is the first question. So, we're going to go through about this key factor 3, which is interest rate. We use lending rate, CPI, and GDP growth. And yeah, so next slide. So this is the interest rate. So we use lending rate. So we can see from the graph, it is a downward trend. So when you see the 1997 to 1998, it has been increased interest rate because of the Asian financial crisis that hit South Korea very hard in that year. So that interest rate started at around 8% in 1997 to 11% in 1998, but then fell sharply to around 4% by 2000. Then in 2001 to 2010, the interest rate remained relatively low. It was a period of South Korea a strong economic growth at that time. The Bank of Korea kept interest rate low to support their growth. And then 2011 to 2022, the interest rate continued to decline in recent years and they nearly close to zero. So this is due to several factors like low inflation, slow economic growth, for example, like during the COVID-19 pandemic and aging population. So the Bank of Korea has cut interest rate to boost the economy, but is also concerned about the risk of increasing inflation. So next. Next is GDP growth. For the past 25 years, we can see it also a downward trend. So from 1997 to 2000, there was a sharp decline in GDP growth because of the Asian financial crisis, so which had a severe impact to the South Korean economy, and so GDP growth then recovered quickly in the following 2 years. So from 2001 to 2007, the GDP growth relatively stable and high during this period, around 4%. It was a period of a strong economic growth for South Korea because of the export and investment. Around 2008, there was another sharp decline in GDP growth due to the global financial crisis, GFC, in South Korea. So while GFC did impact South Korea, the country was more resilient than during the Asian financial crisis, where you can see the differences in drastic decline between the Asian financial crisis and the GFC. So this is because South Korea have a stronger financial system, government intervention, and more diversified export base. So after that, GDP growth has been more volatile in recent years with a mix of high and low growth years. Okay, next is the third one is CPI. So the CPI is showing us an upward trend. Initially start around 60 in 1997 and then fluctuated between 60 and 70 for the next several years because of some factors like Asian financial crisis and the subsequent recovery. And the CPI begins a more sustained upward trend during this period, reaching like about around 104 by 2011. So this period, rising price may due to factors like increasing household income, rising energy costs, and aging population. And then from 2012 to 2022, the CPI continued to rise, but at a slower pace than the previous period. It reached around 125 by 2022 because of maybe slower economic growth, low inflation expectation, and government policy. Okay, so next, we're going to go through the relationship between these three factors. So the first one is the interest rate versus the GDP growth. It's showing us a negative relationship where we know that lower industry tends to boost the GDP growth and vice versa. But however, other factors also need to be considered, like global event and domestic policy. We can see in South Korea also impact in the 1997-1998 financial crisis, despite the high interest rate. So the next relationship is interest rate versus CPI. So showing us a positive relationship where rising interest rate can lead to a higher inflation through increased money supply, but also other factors that need to be considered, like oil price, because oil price is the basic commodity, and in the previous graph that I already show, that the low interest rate did not directly translate to high inflation. And then last relationship is GDP growth versus CPI, showing us a positive relationship where a high GDP growth can lead to increased demand and potentially higher price reflected in the CPI. But however, recent slow GDP growth has not resulted in significant CPI decline, which highlight that other factors also need to be considered on inflation. So the last one is the implication for the South Korean economy and citizen. So these three factors. The first one is the interest rate. Because of interest rate is a downward trend, it's likely to have a positive impact on the economy by making it cheaper for businesses to invest and for customers to borrow. So this could lead to increased economic activity and job creation. Second one is about GDP growth. GDP is a downward trend, which is a concern because it could lead to a slower job growth and lower wages. This could harm the living standard of the South Korean citizen. And for the CPI, which is an upward trend, also a concern because it could erode the purchasing power of South Korean citizens. This could make more difficult for the Korean citizen to afford necessities. So next, I pass
Okay,
to
so
Tony.
my name is Fong Yongjia, and then I'll be taking over for part 2 of the questions. So I'll start with this is the ANOVA analysis regression model that I've run through based on the data that I collected from World Bank for South Korea, and then I'm going to focus on first the coefficient of the GDP and the consumer price index towards the interest rate. So I come up with a regression model. So the usual regression model would be lending rate equals to beta 0 plus beta 1 times CPI plus beta 2 times GDP plus the error term. So my regression model here will be lending rate equals to 14.8 minus 0.04 times GDP minus 0.11 times CPI plus the error term. So if you look at here, I'll be focusing on the p-value of the GDP and the consumer price index. So the relationship between inflation and interest rate, the model confirms that there's a negative relationship because it shows that the CPI and lending rate are both inversely correlated. In a way, it means higher inflation leads to a lower lending rate, aligning with the traditional economic theory. So if the model has a coefficient of negative 0.1108, indicates that for every 1 unit of CPI increase, lending rate will decrease by 0.11 unit in holding GDP constant. So if we move to the relationship between the economic growth, GDP, and interest rate, actually according to the ANOVA test that I found, it shows that it has a p-value of 0.75, which is higher than the traditional 0.05, in which it means that it is not significant enough to prove the relationship. However, since it has a negative value, it confirms it has a negative relationship between the GDP and lending rate of interest rate. It means that they are both inversely correlated. GDP growth and lending rate, they are lacking of statistics, so it is based in the model, and that is I might need more information if I want to research more into this for South Korea. So the implications of the relationship for different stakeholders. So I've broken down into 3 different parts: investors, business, and government. So I'll start with investors. So in the case that it has a low interest rate, investors may find it more challenging to obtain high return if they plan to invest in fixed income securities such as bonds when the interest rates are low. However, they have a substitute option in which they would tend to move their investment towards riskier securities such as equities, because the borrowing costs are low and then the interest rate for bonds are relatively low as well. And in the case that it has a high interest rate, investor will move from their equity investment towards fixed income securities because they are able to get a higher return through a higher coupon rate payment. So for business can benefit from lower borrowing costs during the period of low interest rate. So when the lending rate is very low, business tend to borrow more from the bank to expand their business, and it will be vice versa. During a very high interest rate duration, business will try not to borrow from banks, and then this would actually lead to a reduce in investment and slower economic growth throughout the country in general. So for government, during a low interest rate duration, government may find it less expensive to service their debt, and also it could be one of their strategies to stimulate economic activity through increased borrowing. So they adjust on the interest rate, and then when they lower the interest rate, people would not borrow too much, and then they will spend more. And then during a high interest rate period, it could increase the government debt servicing cost, leading to government budgetary challenges. However, it could also be used as a tool to control inflation. So over here, I've listed out a few limitations for the regression model. So I've separated it into two parts: model limitations and statistical limitations. So for model limitation, the first one is omitted variables. Because we are only researching based on the GDP and CPI, and then there are obviously a lot more factors that are affecting the results, such as unemployment rate, exchange rate, and government budget, and so on. So the second one will be non-linear relationship. The model assumes a linear relationship between the variables, in which it sounds good in theory, but then it might not be the case in reality. A more complex model that could capture a non-linear interaction between the two variables, inflation growth and interest rate, are needed to properly figure out the relationship. And then the third one will be endogeneity. Inflation and GDP might not completely be independent of lending rate, interest rate. For example, higher interest rate could slow down economic growth, but then it could then impact the inflation. So this is quite a difficult thing to establish a causal relationship from the regression analysis done above. And then over the right hand side, the statistical limitations, multicollinearity. Given the fact that if CPI and GDP are both highly correlated, it can be difficult to separate their individual effect on lending rates. So this could lead to a inaccurate coefficient estimate throughout the model, and also standard errors will be there. So heteroscedasticity, if the error term variance is not constant throughout the observation, the model would be insignificant. It could be insignificant, and then the test could be in a way unreliable. So this could require transformation or different statistic techniques. The third one, the last one, will be data quality and limitations. The quality and accuracy of the data could be wrong, in which that it could affect the results. So that there's always a risk through the data that we have collected for the research. So that will be all. Thank you so much.
Alright, so last but not least, for the second one is the relationship interest rate versus CPI. We just realized that we make a mistake and minor adjustment Before this, we mentioned is a positive relationship, but actually is a negative relationship, inverse relationship, where lowering interest rate could lead to higher inflation through increased demand and supply. Other factors also need to be considered, like oil price and etc. So the previous graph already showed that low interest rate inversely translate to high inflation. Alright, that's all.